In this presentation, we will continue on with our corporation comprehensive problem recording unearned revenue. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Information in the upper left, we're going to record this in the general journal, post it to the general ledger, and then create the trial balance from it. Receive payment from a client for work to be completed in the future. So if we see a transaction like this, first question I would ask with every transaction, is cash affected? And in this case, we're going to say, yeah, cash is affected. Received payment means cash is affected. Now, we may not know anything else about the problem, and we probably could just start to construct the journal entry just based on that, because it'll help us to then move forward to the rest of the problem and figure out what to do next. So cash is a debit balance. We received payment, so it's going to go up. The way to make things go up is do the same thing to it, which in this case is another debit. So we know cash is going up, and therefore we know we're going to probably be crediting some other account if only one other account is affected. The only question then is, what will that other account be? Now, when we think about this one, we're going to say, why would a client give us payment? Why would someone give us money? Well, if we're a company, it's because we did work. And so you would think, well, it has something to do with revenue. The question always is, however, when did we do the work? Did we do, here's the payment. Did we do the work before we got the payment? Did we do the work at the same time we got the payment? Or did we get the payment before we're going to do the work? And normally, this is an unusual transaction in that most industries, we either get paid at the same time, think of like a restaurant or something like that gets paid as they perform the service and they get paid at the same time, or we do work before we get paid, think of like bookkeeping or most service companies that have to do the work and then bill the client for the agreed upon work that was done. In this case, however, and in some industries, we're receiving payment for work that we're going to do in the future. And so the reason, because that's less common, it's usually more confusing for most people to kind of grasp that side of things. And because that's more common, we don't even see this transaction as often. However, in some industries, and more, it's becoming more common. For example, subscription-based, like newspapers or computer subscriptions now, we often pay before we get the subscription, whatever they're going to give us, software usage or something. So in that case, we got paid before, if we're the company, we got paid before we provided anything. So we're going to debit cash. We can't credit revenue because we haven't done any work yet. And under the revenue recognition principle, we credit revenue when work is done. And what we're going to credit instead is this account called unearned fees, unearned revenue, unearned fees, unearned income. And that's going to be a liability account. So it's a credit to the liability. Now, again, it's best to do the cash first because then we just know that the other side is going to be a credit and we just need to figure out what the account will be and then think about, does it make sense that we're crediting it? Well, it's a liability similar to accounts payable. The bad thing is going up. Why is it going up when we got money? Doesn't seem like a bad thing. Because we owe something in the future. We owe our services or we owe that money back. Really, that money is not ours until we do the work. So we have this liability, meaning we owe something in the future, hopefully not the money back, but whatever we promised to do. So if we look at our general ledger then, posting this to the general ledger, we're looking for this account and cash. It's going to be in the same order on the GL. So here's our cash account on the GL, and then unearned fees is over here. So it's in order: assets, liability, equity, income, and expenses. We're going to zero in on these two accounts and record the activity for them. So here's our cash GL, here's the unearned fees, here's our journal entry. Cash is being debited by $3,000. And our cash account, notice this is going to start to see a lot of activity because cash is an account that's going to have a lot of activity on the GL, unlike some other accounts like possibly unearned revenue, depending on the type of industry, which may not have as much activity. So cash will give us a good idea of what a GL will start to look like when there's a lot of going on in it. So we can see that we have $40,000 from the prior transaction. We're going to debit it by $3,000. So we're going to debit it $3,000, increasing the balance for $43,000. It's a $40,000 debit balance account. We increase it in the debit direction to $43,000. We can also see the T account starting to form out here. So if you wanted to think about this in a T, instead of like this running balance we have, the running balance very useful in practice, but a lot of book problems, in order to simplify things, won't include the running balance when you're just trying to figure something out really quickly. You'd have this T. So just remember that when you're looking at examples, they might be saying that it's calculated this way: 80,000 plus 3,000. There's our T. So the debits are at 83,000. The credits are at 40,000 if we sum this up. And then the difference is the 43,000. So you can think about this difference either way, as a running balance, very useful, or as a T, which will give us just a quick calculation of a bunch of data in a T format. The unearned revenue, here it is, it's at 0. We're going to credit it 3,000 with this credit, bringing it up in the credit direction to 3,000. So then we're going to use these two accounts to adjust our trial balance, and I recommend doing this as we go each time to get an idea of how this thing is being constructed and to get an idea that we're in balance each time. So the cash account, you're going to get it probably from here. You don't need to repeat 43,000 all the way down. So it's just the 43,000. It's going to be here. That's what's changed. And then the unearned fees is what's changed. All these other accounts are coming from the trial balance as well. However, they're all remaining the same from the prior transaction. These are the two things that have changed. Once we change them, we can double check that we're in balance by taking all the debits minus the credits. And if the debits equal the credits minus the credits will equal 0. And then we can think about, okay, what happened here? Here's our transaction. Cash increased and unearned fees went up in the credit direction. So in terms of the accounting equation, assets increased, all the green accounts increased. Liabilities went up in the credit direction. These are negative numbers for Excel, but they're credits for this worksheet. So it went up in the credit direction. There's no such thing as going, negative in this account. It flips from debit to credit. So it goes up in this direction, and then nothing happened to all of equity. This is all equity. Nothing happened. It remained the same. So if we were to think about this, again, you might want to calculate these a few different ways in terms of your accounting equation, just to see that, just to prove everything for yourself. You can say that these are all the assets. If I add up all the assets and then add up the liabilities and equity, they'll be the same, because assets represent what the company has. Liabilities and equity represents who has claim to them. Assets being the debits, who has claim being represented in essence by the credits here. And you can also think of it, well, this blue side is what is owed to the owner in essence. It's the book value of the company. It's what you would think you would get if you liquidated the company. And that would be all the assets. So if I sold all the assets, sold this, then we would have cash. We would have to pay off these people, the accounts payable and the unearned fees, which would leave us then with the equity balance, the 30, the 70, and the 12,000. Note too that no effect happened here to net income. Net income was 12,000 before. No change to net income even though we got cash, because we have not yet earned that cash. We actually put it in the books as a liability until we earn it. When will we recognize the revenue related to that cash? When we do the work, we'll adjust this at the end of the time period, and we'll see that adjustment in our adjusting entries process at the end of the month. For more accounting information and accounting courses, visit our website at accountinginstruction.info.